Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's take a look at what happened overnight. European equity markets, they were dragged lower by the steel exporters following President Trump's decision to double tariffs on imported steel and aluminium. On Wall Street, shares recovered while investors remained cautious amid simmering trade tensions between the US and China. Among the tech stocks, Nvidia rose along with Meta, while Tesla fell after it reported lower monthly sales in some European markets. Apple shares, they were little changed after the iPhone maker submitted a legal challenge to the EU order to open its closed ecosystem to rivals. The shares of the gold miners surged, tracking a jump in bullion prices, and US listed shares of BHP and Rio rose, tracking the copper price higher. Well, the Trump administration wants countries to provide their best offer on trade negotiations by Wednesday, ahead of a deadline early next month. That's according to a draft letter to negotiating partners seen by Reuters. Meanwhile, the administration has asked a US appeals court to pause a second court ruling that found the president had exceeded his authority by imposing sweeping tariffs on imports, saying the decision jeopardises trade negotiations with other nations. And China has hit back against accusations it violated an agreement on critical minerals shipments, with the Commerce Ministry promising to take unspecified forceful measures to safeguard its interests. Well, with US inflation running above target and the outlook uncertain, Dallas Fed Bank President Laurie Logan has said monetary policy is really well positioned for us to wait and be patient and watch the data, knowing that if the risks are to materially change on either side, we're well positioned to act. Well, US Treasury yields retreated slightly after the ISM manufacturing PMI edged down to a 6-month low. The 2-year was around 3.94%, while the 10-year at 4.44%, and the US dollar has given up last week's gains on escalating trade tensions, while the Polish zloty fell against the euro after Eurosceptic politician Karol Nawrocki won the second round of the presidential election. The Aussie rising about 1% to 64.9 US cents. And Bitcoin is trading close to 106,000 US dollars. Well, oil prices climbed on supply concerns as producer group OPEC Plus decided not to accelerate plans to hike output, while wildfires in Canada's oil-producing province disrupted production there. Brent crude futures close to 3% higher at almost $65 a barrel. Copper rose more than 3.5%. Iron ore was down to $97 a tonne, and gold climbing to a 3-week high as a weakening dollar and rising geopolitical risk and economic uncertainty fuels demand for the safe haven. Spot gold up more than 2.5% at $3,379 an ounce. Let's get across what we're seeing, particularly with a focus on US markets. Steve Sosnick joining us again from Interactive Brokers. Steve, welcome back. Been a couple of weeks since we've had a chat. What's it going to take to derail investor sentiment? You make that point there. Given what we saw over May, its best performance for May in 35 years.
Yeah, well, good morning, Andrew. I think right now, just investors are in such a positive momentum mindset. This has been going on for weeks. We've been, you and I have been talking about it for weeks. And it's one of these things right now that the market's just decided that all news is okay. And, the negative tariff news, I mean, you've probably discussed the phrase, the taco trade. I don't want to get into the politics of it, but realistically, each time a tariff has been threatened, it's either been postponed or rolled back or somewhat of both. And then, of course, the courts are stepping in right now, possibly to prevent them. So the markets basically just shrug off tariff news to the point now where the half-life of each negative tariff story is so short that I'm starting to wonder at some point if they're just not going to be taken as good news before they before there's a sell. Forget the dip to buy, just buy it anyway. That would probably be something to be very concerned about. But in the short term, that's right now the momentum is just it's so positive, so powerful. We've seen incidents of this before. It's the latest in that kind of motif.
What do you feel as though ahead, though, are the likely catalysts to move the market either way?
Well, right now first of all, I think the market's just sort of running on fumes to some extent. But that can go on, that can go on for quite some time. Obviously, one of the biggest catalysts would be the jobs numbers that come out on Friday. We're expecting a bit lower in terms of payrolls employment, around 130-ish, just sort of the expectation. Unemployment rate staying at 4.2%. Monthly hourly earnings going up by 0.3 as opposed to 0.2 last month. So this is basically the same. It's a little bit of weakness in the workforce, but considering the Fed governor talk that you just began with, Lori Logan is just one of many who's saying that we're prepared to act in either way or the other. But I would think it would take a number from something like the unemployment report to get them to move one way or the other, because I think that Powell certainly among them has indicated that he's more concerned about restoking inflation than he is about, employment concerns. And honestly, a 4.2 unemployment rate is pretty darn good. So why would that present a problem? So I think we're just seeing, that this month can pick up where we left off again. You put it on the chart earlier that VIX is around 18 or so. We're not quite fully complacent, but we're getting back to it. So I think something that shakes us out of the complacency, whether that's CPI number, whether that's consumer sentiment, or whether that's tariffs. Actually, my biggest concern is bond vigilantes, because I do think that, one of the aspects of the tariffs are they're used to provide some economic cover for the budget deal that's going through, which depending, it's going to raise the deficit or the debt no matter what we do. But if you take away the idea that tariffs are going to provide some of the monetary support for it, at some point the bond market could start to freak out, and if that happens, that's the trigger. But I don't know what triggers a bond vigilante very specifically. They're a funny group.
Well, but still, maybe Donald Trump would take a look at that as he did last time, I guess, when he made some changes there. But obviously, with those yields continue to rise and the US dollar, that weakness. I mean, what are your expectations for the US dollar at this point as to where its likely trajectory is going to head?
The dollar is definitely headed south against almost all of our trading partners. This to me is telling me that there's capital flowing out of the U.S. And that's one of the places that could be a bit of a problem from the sort of the bond vigilante aspect of it. If you're starting to, to me, the nightmare scenario would be just, Japan, China, German investors just sort of boycott a U.S. bond auction, and that would be just that freak out about the fragility. I don't know that they're willing to do that because they'd end up having to mark down all their other positions as a result. But I think this weaker dollar is definitely problematic. It's helping boost gold. It's helping boost some commodity prices because certainly, when you're talking about the rise in copper, it's not because there's this great economy pushing the price of copper, especially with real estate issues still continuing in China. But again, commodities are sort of the anti-US dollar because they're priced in US dollars. And so in a short-term case, you could look at this as an equity investor and say, if you've got a multinational company, a weaker dollar is good because if they're earning profits abroad, revenues abroad, those translate into bigger numbers. But taken to extreme, if it's the result of capital flight, and if not flight, I think it's more of a drip than a flight right now. We did have some flight, but I think we're just it's more of a slow ooze, for lack of a better word. But those are sort of the things that could upset the apple cart.
All right, Steve, let's talk portfolio positioning then. Now, clearly, sell in May didn't work, did it? So now we're in June. What do you do, particularly ahead of, I guess, the next key date as far as trade and Trump are concerned, those tariffs, is July 9th, which has been billed as Liberation Day 2.0.
Well, I think the market is calling his bluff and saying they'll get extended again. There was some report that came out pretty much just after we closed that some of the China tariffs were going to get pushed back again. So the market is just calling his bluff constantly on that sort of thing. I think, I think the strategy here is, you really have to make a decision here. Are you a momentum trader and you're just going to continue to ride these momentum stocks, until it doesn't work? Problem being, if it doesn't, when it doesn't work, which all momentum does run its course eventually. But the question is when and how painful when it doesn't. Or do you just sort of say, look, there's still value to be had in lower volatility, higher yielding investments, which are actually in many cases doing quite well. Philip Morris, for example, has been a good performer. I don't own it because I don't smoke. I don't understand the company too well, but I understand the fact that it's a low volatility stock with a nice dividend. So these are the type of stocks that have somewhat come back into favor. Campbell Soup, which was given up for dead, had a good quarter because people are eating at home. So I think we need to start. I think it does still behoove us to be a bit more defensive. The consumer sentiment numbers stink, but again, consumers tell you one thing and do another. A lot of times. So you want to watch any numbers that come out there. So I think from a strategic point of view, I think it behooves you to be a little, to take this opportunity and move to a little bit less exciting type of investments, shorter term fixed income, that kind of thing, because it doesn't appear the volatility is ending, but it does appear that the momentum run is getting a bit tired. On the other hand, though, that can persist. That it can look tired for another 3 months before anything goes wrong. So it's hard. You don't want to fight this tape. But again, if volatility starts to get lower, maybe your other strategy is just hold your nose, buy the momentum, and buy some puts against it.
Hold your nose, indeed, Steve. Enjoy your week ahead. Thanks for joining us from Interactive Brokers.
Thanks, Andrew. Take care.
Let's refocus then locally, and we are expecting a very strong start when we get underway here. SPI futures are up more than 0.8%. So stay with us. We're going to get across that in just a couple of minutes.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.